and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for today's culling of the markets, I guess. NVIDIA's having a bad day today, and all of the semiconductors. News out of China. Basically, a new company coming out saying that we can do AI better for a lot less. Everybody is panicking. NVIDIA's having its worst day in years and years and years, probably worst day ever. Market is down in NVIDIA about 16%. That means the stock is down around $19.62. It's dragging the whole market down. We have the S&P 500 index down 100 points on the day, exactly, actually, right at 6,000 at this second, down 1.69%. And we got the VIX index spiking up around 1827. Now, interesting enough, the one stock that's holding its own is Apple. Apple is up actually 2.3% on the day, trading $5.23 higher. So the fact that Apple's been beaten up recently gave it an opportunity for it to bounce back, thinking that maybe AI might be cheaper to implement than anticipated. I guess that's the thinking that's behind it. So everything is irrational at this point in time. There's no real numbers. We're dealing with China. China's always the bad person in the mix, and if you can blame China, that's a great way to go about it. And right now, the market is I guess trying to hold its own relative to the cap spend that has been on AI. We just on Friday had Mark Zuckerberg from Meta come out and say that they're going to commit to spending $60 billion on AI and the build out of AI inside their platform. And in some ways, if this is true about what's going on with the Chinese company, maybe that $60 billion will get them more. The fact that they are willing to spend that amount, or maybe they don't have to spend quite as much. They haven't spent it yet. They just committed to it. So very just panicky situation in the markets. We have a plethora of earnings. So this, Netflix came out, had a great earnings report, had really good comments in their conference call. Subscribership is up. They're looking to raise prices. The stock took off. That was the start of the Meg 7. Now it looks like we're going to have Apple announcing this week. Where Amazon's going to be next week. We also have Google announcing this week. This is the heart of earnings season. And this news item has really just really tossed a lot of ingredients into the mordial soup, if you will. So last week we looked at a trade in Amazon and we adjusted the trade. So luckily, we did an adjustment on our Amazon diagonal spread heading into that company's earnings report. Tomorrow is Apple. Let me see what else we got this week. Okay, so we have Wednesday after the close, we have Tesla, Meta, Microsoft. Thursday after the close, Thursday is Apple and Intel and Visa. And then on the 31st, on Friday, we actually have ExxonMobil and Chevron. So we have a couple of energy companies. And what else? There's one other here in the mix. Tuesday we have Boeing. Boeing should be interesting. JetBlue is also announcing on that day. So, yeah, definitely an interesting week as far as earnings are concerned. So today I decided to make the show about protection. I want to try to come up with, I think, an interesting strategy that you'll like in NVIDIA. It's kind of a dead cat bounce strategy. I don't mind if you're still bullish on the underlying. This is one way that you can address it. Another way is I'm going to give you all of the strategies that we can address in NVIDIA. We might look at the Apple trade or the Amazon trade, but we already rolled that trade. So if anything, Amazon right now is down only 1%, but $2.64. The fact that we rolled the position, maybe we close out our short leg. We'll take a peek at that and see where we're at. But the theme today is NVIDIA and protection, just like the title says for the show. So let's run to the Tradier Pro software. And now, remember, the preface is that we're going to have 100 shares of NVIDIA. we're assuming you own NVIDIA in some way, shape, or form. We're not trying to get bearish on the NVIDIA, which would have been a great trade on Friday, right? But we're not saying that we have a bearish outlook on NVIDIA. What we're trying to do is get you through this panic period. They are announcing earnings in February 22nd. I think it says the 28th. They're saying the 26th. Okay, so this earnings report is February 21st. That one, okay, that's why the 28th is highlighted here. So it's between these two expirations, between the 21st and the 28th. NVIDIA is expected to announce on the 26th. So something to try to get you into some potential good news in NVIDIA. So I don't want to go out till earnings, but you can apply some of these strategies to this. And you know, the market's already started to tank a little bit. So one of the things that you can do, the simplest thing, is try to sell some of this implied volatility premium. But the issue with that is you could get a snapback in the underlying stock, and you could peg your stock at a certain price. So if I'm going to do this good old covered call trade where I'm selling some of the premium, we see that implied volatility has jumped, has spiked. As a matter of fact, this is interesting in that the nearer term options are trading at or above the implied volatility after the earnings report. So on February 28th, we're showing the implied volatility at 64%. This is the one that contains earnings. And February 7th, we're showing the implied volatility at 69%. So the first trade is a trade that you have to act on today. To me, you have to do it today because you want that implied volatility premium. And so you're going to get some extra, you own some stock. Once again, you're going to have to manage this. So you might have to roll if you don't want to get rid of the stock. And that's the only real concern here. But we'll look at the February 7th expiration, 11 days out, and we're going to sell a call on your 100 shares of stock that you have in your account. You have to have 100 shares. So if you have a smaller share amount, it doesn't work because you can only sell a call on 100 shares of the underlying stock because each option contract represents 100 shares of stock. But the premiums are pretty nice, not bad at all. We started the day, the stock was around 140, right? Because we're down 21 right now. So 142 if you want to be a little bit more exact. And if we come in and sell the 126, that could help us out throughout the day. Because here's one of the things is if we do get a bounce back, this implied volatility is going to start going back down towards the historical. It's going to start creeping down to 40% implied volatility, more than likely. And so this is an implied volatility play as much as anything else. But you just don't want to get pegged on the stock. So how much premium do you want to sell? And where do you think that the snapback could be if you do think that there will be a snapback in NVIDIA and there'll be a move back to the upside? Or maybe you think NVIDIA is going bankrupt. Who knows? But in general, the company is still solid. All they just had was a news headline about a different company that is in China that we know absolutely nothing about that has proclaimed that they can do AI cheaper. That simple. Okay. So the 130 strike, which is at this point 9 points higher, about half the move of today, you can still bring in $2.76. So that will give you some protection from this point on down, $2.76. If we get to move back, this should lose just because of implied volatility. So I don't mind doing this trade. Obviously, if you snap back and it hits 130, you got to worry about the gap opening. You can still roll. You could roll out to the February 14th to the 21st. I just don't want to roll all the way out to the earnings. So I would set an alert at the 130 mark, and this is where I would be maybe selling an option contract to try to bring in some protection on this. Now, if you're still nervous and you want to stay in the same range and you want some protection on the downside, you can give up this premium. So the way that we do that, this would be a covered call. And let me get rid of this just so that it doesn't screw you up that much. Okay. So we're going to hit that bid on the 130. Now, the other strategy is called a collar. And it's really how much protection you want to bring into your account. So if you're going to go 11 days and you're nervous, right here, you're paying 260, you're receiving 265 for this. Do you want to buy the protection right here? Like you're thinking, I'm going to panic, I'm going to sell, I'm going to get out of this position. I don't want to own NVIDIA anymore. This is an alternative. This is an alternative to that strategy. So you pay 268 for this. Maybe you buy the zero, well, basically $1 protection, right? But that would mean I'm going to buy this put. So I'm selling a call to pay for the put. I'm giving away potential upside opportunity to lower the cost on my put option. So if I do this, 277 is the midpoint on the trade. This would be the collar. Once again, you're assuming you have 100 shares of stock. And so I have to pay that $2.77 or $2. Well, let's just make it 280. Let's put it in there at 280. Minus the deductible, which right now is about $1. So you have $3 of $3 of risk total on this position. And then you have unlimited downside protection, right? So if I do this strategy right here, I have protection from 120 all the way down to 0 in NVIDIA. That's what the thought would be. If you want to get really crazy, you could then come out and actually sell maybe the 105s and gives you 15 more points of downside protection. So now you have a three-legged trade on, and there's no margin requirement on this, okay? So we start off by selling a call, the 130 strike call. You can just do that, give yourself a little bit of protection on the downside, costs you nothing. It costs you an opportunity risk. It's a position that you have to manage if the stock gets to 130 and you don't want to get rid of your 100 shares of stock. You could sell that call, make it a collar. So I sell it, and then I buy the 120 strike. This is my protection, my hedge. It's going to make my insurance a little bit cheaper in order to do this, right? So I'm cutting my cost of insuring this position in half. Still have to manage it if the stock bounces back. But then from 120 on down, I'm not nervous anymore. I don't have any more risk on that trade. Now, that is the full-blown insurance. From 120 all the way down to 0, you have protection on NVIDIA for the next 11 days. Other alternative is to come in and say, I'm going to buy this, but I don't need protection all the way down to 0. I'll look at where the one standard deviation move is at, right around the 105 level, and I'll sell that. And now I'll even reduce my cost more. So let's hit that bid. All right, now I'm down to 124. I have giving up some upside opportunity if I get a snapback, but I have a long put spread from 120 down to 105. Fairly inexpensive insurance because I'm reinsuring from 105 on down. So as far as an insurance company is concerned, you buy the put, that's a protection, that's a 100% protection. You pay the deductible and the premium, you have protection all the way down to 0. A lot of insurance companies will come in and say, I got too much risk here, I'm going to reinsure, and they sell off some of the risk on the downside, and that's exactly what you'd be doing on this put spread. So you could do this three-legged gaggle of securities and protect yourself in this range. Once again, though, my biggest concern is a snapback in the underlying stock, and before you know it, stock is at 130, and you're pegged on this position and have the obligation to give it up at 130. We're only going out 11 days. It's very short-term protection, but if you're thinking of selling NVIDIA right now, this is an alternative to just going out and just getting rid of the stock. Okay. Now, you can take this leg, the 130, and you can just remove it, right? Boom. Now you're paying $4, and your break even, this isn't quite as enticing, but your break even would be 120 minus 4 from 116. So from 116 on down to 105, you would have some protection, but you're paying $4 for it. So you're still, even though we're doing a bear put spread, a put debit spread, the protection is still expensive. I'm not nervous about it going below 105, especially over the next 11 days. But I wouldn't be buying this outright. I would try to get some of this premium from the 120 strike and this would be the range that I would be looking to trade it in. Implied volatility is way too high, and you're worried about implied volatility coming off. If it comes off, it's going to hurt the 120, but it's going to help the 105 because you're long the 120 and you're short the 105. So that's the main reason why I would do a put spread if I'm just going to buy protection outright. All right. Now, with chaos, there also becomes opportunity. So this next trade is an opportunistic trade on NVIDIA, but once again, you're giving up some potential upside opportunity. So this trade, a lot of people don't think of a lot. I like to call it a covered call on steroids. Okay, so let me show you this inside the options playbook. So pop out here a little bit here. The strategy that we're going to look at is a front spread with calls, and then we're going to modify it. And I'm going to talk a little bit about what that looks like on the end. So, all right, here we go. Let's go back to options playbook. Okay, so here's my book, optionsplaybook.com. This is the companion website for it. If you look at a front spread with calls, okay, front spread with calls is a very interesting strategy. Not a lot of people do it though, and here's the reason why, is that you buy a call at strike A and you sell 2 calls at strike B, right? So I'm selling 2 calls to pay for a call. The stock is somewhere in this area. If the market goes down, you receive a net credit, right? So if you're incorrect on your forecast, you receive a net credit. But if the market comes up, you have good potential between strike A and strike B. But if the market blows away and skyrockets, then you have a lot of risk. So as far as the brokerage firm is concerned that you're trading with, the fact that you have sold 2 and only bought 1 means you have unlimited risk. And a lot of brokerage firms won't even let you be naked short a covered call without the right approval and ridiculous margin requirements, right? Because they just are worried about the black swan event taking the firm out. Well, guess what? If you own 100 shares, that's not an issue because you are short 2 calls, but you are long 100 shares and you are long a call. So if you're thinking, all right, this is just overdone in NVIDIA or any of the semiconductors, Broadcom, any of the stocks that are getting beat up right now, if you're saying, okay, this is overblown, we still don't know exactly what's going on, what this new company is, nobody's even explored the software that's behind it as far as the big mega cap tech stocks. So maybe it's something that they can lean on, because obviously you can look at the technology and see what they did or what the secret sauce is, and try to get some hints from it. Okay, if it's all that they say that it is. Okay, so let's go back, and if we look at this trade and we combine it with stock, well, then things get interesting. Okay, so let's go back. Covered call on steroids. All right. That's what I'm billing it as, but it's a front spread with calls in the playbook, and you own stock. Oops, how did I do that? Moved the wrong one. 1 second here. So we're back in the saddle again. And if you have any questions, I always kind of forget to mention this, but you're always welcome to put them in the chat box. I'll try to address any questions that you may have. So now in this instance, we're going to go out to I'll start in the what if calculator. Okay. And we'll take this strategy and I'll send it to the ticket. Okay, so now it's down below. So right now you can do this front spread for a net credit of 45 cents to the account. I'm going to remove the NVIDIA stock, and it's going to look very similar to the graph that we saw in the options playbook on the website. So if I remove the stock and I pull it down, this is what this trade looks like by itself. If the market is right here at 121, if the market goes down, we make 46 cents. Not that that's I mean, it's not nothing, but obviously we've lost a lot more money than 46 cents today in NVIDIA. So on the way down, here's where you're at. On the way up, doesn't really do much for you until you get closer to the expiration. And by the way, these are the 14th, February 14th expiration. But from 131 all the way up to 137, for every dollar the stock moves up, we're going to make $2 on the upside. So for every dollar it goes up, we make $2 on the upside. All right, say that again. So for it basically looks like we own stock on margin. But when we get to this level, well, now we're going to have risk because we might get pegged on our stock. So let's go back and add the stock, the 100 shares that we've been talking about that you already have in your account. So let's look at that, right? And now this is how it looks. So you're down on the position. If you get the snapback that we're saying might be possible, stock's still hanging around 121, and it comes back to the halfway back to the 130, 131 level. From 131 all the way up to 137, it'd be like you own 200 shares of stock. So from 131 to 137, for every $1 that NVIDIA goes up, if you can get the snapback towards the where it started today, where it started was right around 141. But if you can get that type of move, for every $1 that it moves up, you would make $2 on that position at expiration on the 14th. So for every $1 it goes up and you make $100 on your stock, and from this point to this point, you would make $200 on your stock. And this, what makes it enticing is that there's so much pumped up implied volatility from the down move. So once again, these are strategies, but there aren't strategies that you can really think about. The covered call, I'm probably not going to do it 2 days from now because implied volatility is going to come off. This strategy, same situation. I might not be able to get it done for a net credit with the same strikes if the stock is just kind of hanging where it's at. If I'm nervous and I'm thinking about selling, I'm going to do a bear put spread. I'm going to do a put debit spread as opposed to selling the stock outright and as opposed to just buying a put outright. I'm going to protect myself for the next 15 points as opposed to going all the way down to zero by buying the at the money put and paying $5 for that position. I'm going to try to make that cost a little bit lower. But this is the way that I would approach it. I would also think about a zero cost collar. But I like this strategy right here, where you own 100 shares of stock. You're going to have to manage it. It's not something that you got to put in because you still got risk if it gets called away. You get a bounce back over the next 14 days. That's great. If you get the bounce back and you don't think it can go beyond the 140 level or up to the 140, 142, right back where it was, well, you get some help in between here. If it continues on down, well, you still got the risk of owning the stock. If you want to get out of the position, you can, and it goes down, well, this should be trading for less than where it was at. Anyways, you just close out this position and sell the stock. That's simple. So it doesn't lock you into the position to the 14th. I guess I should emphasize that. That's fairly important. And if I'm looking at the entire trade and we go back to the position here, right now, the net credit, I'll put it on there, 50 cents. I like that. Let's keep it right there. 50 cents. And here's the trade. Stock's at 120. You're hoping for it to come back and get towards the 131 level. From 131 to 137, rise over run is 2-to-1, right? For every $1 it goes up, you're going to make $2 at the expiration on the 14th, 18 days away. And then from 137 on up, you have the risk. The thing that makes you nervous is if you go beyond that, you're going to have to roll one of these to avoid assignment or buy one of them back, right? Because you're short 2 and long 1. All right. Any questions about that? Okay. So let's go back and recap. If you just are nervous about the short term, selling a call, selling the 130, bringing in $2, selling the 127, bringing in $3, only going out 11 days, trying to capture implied volatility. Not a bad way to go. Realize you're giving up some upside. Next thing, you can sell that call, use it to buy a put. So you lower the cost of your put, give yourself some real protection on the downside. But once again, giving up some opportunity on the upside. You can then lastly sell this call, buy this put, and sell this put. So it's a three-legged trade, but it's still simple. This is all centered around 100 shares of stock. But now I've lowered my costs down to $1. I'm protected for the next 15 points on the downside. I got to pay a little bit of, well, we're at 120 now, so it would have been good to do it at the top of the show. But we're down $1 on it. So I want to lower my cost, but give myself some protection over the next 11 days, or you could do it to the 14th. And then on the other side, you just say, okay, this is completely overblown. I'm going to take advantage of this pump up in implied volatility, and I'm going to do a front ratio spread on my 100 shares of stock, which means I'm not going to be uncovered, and I'm going to hope for the snapback. And if I do get the snapback, I'm going to basically own stock on margin from 31 to 37. Those are the three scenarios. You can go back and look at them. All right, so now Amazon, we did the trade. It's down 287. The one call option that we had, let me go back and take a peek at it here. The only thing that I might do with the stock down, because once again, this is all just based off of none of the companies have really announced earnings. We have earnings that are going to be catalysts coming forward. And Amazon is down with the rest of the mega cap techs. The NVIDIA is probably dragging them down. But we sold the 255 call for $2.30. And that is the expiration after earnings, which is the 14th. Let's see where the 255 call is in Amazon. If it was low enough, 255, it's 213. No, we haven't made enough on it. Yeah, with the pump up in implied volatility, we're actually only up about 20 cents on the trade. So no reason to, you just keep it right where it's at. If this got low enough, where would it have to go? 255. Stock would have to go down another, 20 points. Because if it went down 20 points, we'd be looking at the 275 strike right now, right? That would be 20 points lower out of the money. And then you could buy that back for 40 cents, and then that would make sense because we received $2.30 for it. And that would, so no reason to look at it at this point in time. We'll ride it into earnings in our long call spread. And hopefully we get a bounce back up towards the 255 level when it's all said and done. All right. I don't see any questions, any concerns, anything else? No. Well, that's it for this edition of Options Guide TV. We'll see you on Wednesday for the next edition. We'll see how this all plays out in the semis. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.